Hi, this is Randy Finney with Right Side of the Chart, and this is an early session update for Tuesday, December 19th, 2023. It is 10:07 Eastern Time as I'm starting the video, so we're a little over the half an hour into the trading day. And I just wanted to update the recent trades I laid out there, kind of trading plan. I give you some suggested stops, price targets, various things, commodities and equity indexes and bonds, and you name it. It's all about asset allocation, diversification. That's key to investing and active trading. So this is NQ, the same chart I got out to you this morning. Just to recap, you've got this little minor trend line, nice and clean, lots of reactions there, and so that's the one we need to take out. In fact, it's either this week or even going into last week. I was highlighting this when I got it out in several of the comments. Took a screenshot of this chart, covered it in a video in the last week or two, a couple times. Is saying that needs to go to get the next sell signal. And again, I gave you what was a short-term pullback trade, just two targets, probably come down here, hit T1, which is this longer uptrend line, and then get a reaction there most likely and come on down to T2. And then depending if and when that we get that, I'll let you know my thoughts on these two potential additional targets. Again, for a short-term trade, active traders, or we'll see. Let me go over a few other charts and I'll show you some other things that you could still, let it run if we do break down. That's always a possibility. But I'll speak to that in a second about this drift up we're having right now. We're a week out from Christmas, not even, a little less than 6 days out from Christmas. Of course, you have markets are closed that day, abbreviated trading sessions that week. So you have a truncated trading week. Super low volume, so I'm going to get to that in 1 second and talk about the kind of the drift up that we're in and what it means and where we might go from here. So that's that. Let's keep it simple. Sell signal, no sell signal right now from this setup here, but you'd need to take out that trend line. If you do, it's pretty well defined. And like I said, I'd put a high probability that we'd pull back to at least T1. And that's going to be about a 2% drop. Again, depending if it breaks today. And then if T2 is hit, depending if and when it gets there, that's about almost a 4% drop. Probably come down here, hit T1, get a little bounce off T1, and then come down there, hit T2. And then, again, if and when it triggers, I'll give you my thoughts. All right, let's look at QQQ. Same chart, and I got this one out to you this morning as well. And this is the same thing. So you have a minor trend line right here, again, that needs to break to trigger the sell signal for a pullback trade. You have the divergence that's been building. Even here, you can see this RSI and PPO starting to, the divergence is increasing or steepening the slope of the divergence lines right there on this latest thrust up. And again, we're drifting up, on lower and lower volume, which makes sense. It's the holidays. And you can see the volume price histogram, big bars right here. So that T2 is a what I call a high probability target. Again, if we get the sell signals. The setup is just that. There's two types of trades I post. Actionable, meaning boom, hey, here's something, it just broke out or it looks objective here. And then trade setups, and that's what this is for active traders. So that would be it. And again, I just measured it on the futures, but it's about a 4%. Yeah, right, almost to the button from where we are to that T2 if hit. And then what this is BRWMT. That's bearish rising wedge measured target to be determined. Why to be determined? Well, you take the widest part of a wedge, which I've done here. You know what? Let me fix that a little bit. That would be, you want to come about right there. And then I'm using the bigger, larger, more significant uptrend line. So that would take you down. The bearish rising wedge measured target, if, again, to be determined, because first of all, number one, we haven't broken down, going up. If we get the sell signal and then we break this trend line, depending on where we break it, that's where I move this line if and when. So maybe we can go up more, and then that comes way up here. Well, up here. As of now, I'm just going to leave it right about there. This looks pretty ripe for a breakdown soon, probably today, my guess, and then we'll go from there. Next up, let's talk about the VIX, highly related to the stock market. I've covered this quite a bit recently. Not much of a change in the last week or two. If you recall, I'm going to roll back here. This right here, you can see my lines. This is the support zone back from 2018 This is 2018 here. 2019, look at how many reactions on there. 2019. So I had it back here, support zone, divergent low, pop. Oops, that's not it. Divergent low, rally. Divergent high, correction. Divergent low, rally. Divergent low, another rally, a big one. That was when COVID hit. All right. And so that was the floor for the VIX back at that point in time. As I talked about in recent videos, the VIX over different periods of time has different floors. This was the floor since COVID up until recently, and now we've come back to that old support zone. It was support then, most certainly should and probably will act as support again. So I just wanted to point that out. We're right there. The support zones, these two blue lines, and we've come almost, we perfectly hit it at the top. And again, we had big divergence there. So this would indicate something to come, whether it starts, in December, January. But the one thing I would much prefer to see would be a better defined trend line in which to break it. See, this is divergence. As I often talk about, divergence, is not a sell signal. It's a condition, and it can continue to build, and more often than not, it plays out. And sometimes, once in a while, it doesn't play out, gets taken out. But this one looks like, again, we're at support with positive divergence, just like you had it here. You got the rally, then you had the divergent high. You can see it on the 60-minute chart. It's simple, really simple stuff. Wash, rinse, repeat. That's how it's played out. So that's where we're at. And then you go to the weekly chart, and you can see, remember I talked about those floors on the daily chart. This goes way, way back, and you can see there's different. These were the extremes, and going back decades into the mid-90s. That was an extreme low, but for the most part, this right here, this is your support zone, and we're coming up on that on the weekly as well. So just kind of put in perspective where we're at. So if the VIX happens to drift lower, if these divergences happen to continue to build, then this is the bottom of the support zone we're coming up on right there. And there's a trend line, pretty significant one, I think. And as I've talked about many times, especially recently, this is where the previous bear markets ended. Back then, you had this was a ceiling, if you will, on the VIX. And then since 2009 to 2021, this is where all the corrections in the bull market that started back in 2009 ended right here. Boom, boom, boom. And this was COVID. And that was the end of technically, the real bear markets in the last couple decades. If you want to look at it, in percentage drops, S&P dropped 36%. And that's what the VIX tracks of volatility S&P. So that was COVID, even though it was over before you knew it, 36% drop. And that was the 2007 to 2009 bear market and the Great Recession. And you can see, so we didn't even hit, as I've talked about, we didn't even come close to the level that has ended all the major corrections since the bull market started back in 2009, this last time around. So yeah, that's just something to note. Okay, there were several comments under this post from the other day, yesterday's crude oil update. I'll get to crude in a second and give you a more recent update. Comments, and we'll zoom in so you can see them. Can you include the original T1 and T targets? Yeah, that's what I did. I took the screenshots up here from the video where it was laid out, and those were the targets as covered in the video, 1, 2, 3, 4. But I made a point too, noting on the updated chart that the futures have rolled. That was on the January contract. Now we're on the February contract. Crude's a tricky little sucker. That's why you got to know futures when you're trading them. The January contracts expire in December. Unlike, stock futures, they expire in the month that they say they expire. Crude and some other ones are different. So we're now on the February contract. So what happens is the price levels change because it's a different month future. All right, so that's that. This is a good one. More runaway to run. Why is Apple falling back? That one day doesn't make a trend. Didn't really answer that because it's just one day, again, doesn't make a trend. Apple maybe fell back a little yesterday because of that news on the iWatch, which is probably whatever. It is what it is, but it's probably going to just be a net positive for Apple. Everyone's going to run out and buy the watches that are on the market, and then they're going to start shipping them again in January. So again, that's just a non-event to me, really. All right, but this is important. So markets drifting higher on fumes, declining volume. Okay, you can check the average volume and look at that. And also keep in mind that is normal and heading into the end of the year. But because the shorts have been squeezed out and are afraid to re-engage without some solid sell signals, which we certainly don't have, there's momentum, no sell signals. Plus, the last few weeks of December typically suck for shorting the indexes. Again, that's just my opinion. That's why they call it the Santa rally. Again, playing probabilities. QQQ short interest is at a yearly low, at least possibly a multi-year low. I'm going to show you that in a second. This is something I haven't covered recently. And there's that whole Newton's first law of motion says a body will stay in, a body will stay in motion until and unless acted upon by an equal but opposite force. So therefore, when sellers are missing in action, stocks are going to drift higher until they equal or outnumber the buyers. In other words, there's more sellers. And remember, guys, the stock market always has a steady bid of guaranteed inflows from buyers of 401k. They call it the 401k put. So you always have 401k contributions coming in. And so you need to just kind of break that cycle and then change the trend. Still awaiting a break of this minor uptrend line on the 60-minute chart. That's the one I got at to you again this morning, and it was here yesterday. Followed by another break below the primary uptrend line. So again, this was just yesterday, same chart. Waiting. No sell signal yet. And then, but let me show you. Here's the short interest on QQQ, and they report it. They take readings bi-monthly. But the lag time to report, even though the periods are the mid-month and the end of the month, but there's like a 2-week period or 10 days, over 10 days between the actual reporting date and the dissemination date. So the most recent we have is the end of November. And you can see here, short interest on the Qs was 58 million shares, right at 58 million, just a hair above. By far the lowest, at least in the last year. This only populates, this was from NASDAQ site, website. They don't go back any farther. You can dig around, find other charts, but what that shows you is, it confirms what I'm saying. The shorts have been getting squeezed out, and from these extreme lows in short interest, just like extreme highs in bullish sentiment, usually come the biggest drops, because when the shorts have been blown out of the market, and the last bull has bought his or her last share, and again, I'm speaking metaphorically, not literally, there's no one else left to buy. And then when you start correcting, you don't have the normal shorts you have when the normal range is about 70 million shares, 75, 80, 86. Short interest was really high back then. And again, you can correlate these charts with the big drops in the market. So it's these extreme lows and the extreme highs you want to stay away from. So you want to be again, in a vacuum. But one factor is typically you want to be getting bearish and short and less bullish when short interest has dropped to extreme lows and sentiments at extreme highs, and vice versa when short interest is spiking up and sentiment is very low. All right, so I wonder if Newton was a bull or a bear. Well, my reply, he was very big on that whole gravity pulling things back down to earth thing. So we'll see if gravity pulls this market down. And speaking of valuations and everything else and the lag effect, this one, I've talked about this quite a bit. So, someone said QQQ record high, Dow record high, SOX record high, S&P 1% away, and interest rates have just started to come down. CME has a 63% chance that Fed starts lowering in March. Exactly, that's what I've been saying. But see, it's perspective. What I look at is history, and that's exactly what I've been saying in recent videos. So here's a chart. And let me just read my notes here real quick. With very few, if any, exceptions, the end of a Fed hiking cycle and start of a rate cutting cycle has always been followed by recessions or bear markets or both. Fortunately for flexible, meaning long traders that will go long or short, and those that take the time to study history, is in the chart below, the masses, which are a majority out there, which are driving the market up, they see the headlines and they immediately assume a new rate cutting cycle is going to equate with a bull market instead of a bear market. Okay, here's the chart. Maybe this time it's different. LOL, just kidding. You know, that's same as John, I think it was Sir John Templeton that said, you know, maybe this time is different. Is, you know, be careful. Those are the like 4 most dangerous, or what is it, 5 most dangerous words in the market. The most important takeaway here, and this is important before I get into the chart. The most important takeaway is the fact that it can take months. Again, see this chart below. I'm about to expand. After the Fed stops hiking, before the recession and or the rate cuts start. So this is not an exact timing indicator, rather a pretty darn accurate predictor of a high probability of an impending and relatively imminent recession. Again, relative is to anything you're speaking in the time frame you're talking. We're looking at a chart here, so it's relative to this. This goes back 62 years. I added the purple arrows in the notes here. Let me see if I can expand it. I don't think I can in the video. Let's see, 1 second. I'll see what I can do for you. You can go in the site and get it. Yeah, there it is. All right, let me scroll down a little bit. Come on, let's see here. Let's do this. All right, that'll work. Okay. You can see my arrows, and if you look closely, these shaded gray areas here, 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 these are recessions, right? And this is, again, we're going back. There's enough data points to make a statistician happy. You don't have just 1 or 2. Again, it's kind of almost like the yield curve, the inversions in the yield curve. There's enough, and it has 100% reliability. But remember, with the yield curve, I didn't cue that up here. You've heard a lot about it lately. It's been inverted for almost 2 years. But it's not the inversion. It's the what they call the uninversion. I like to call it reversion, but uninversion. When the yield curve uninverts, that's when the recession is imminent. So, and that is getting very close to happening now. And if the Fed brings down the short-term rates, which is almost a near certainty for next year, then we'll get the uninversion. So that there's a mountain of evidence, as much as I've ever seen, at least since the last recession. Enough evidence by these two. These are 2 of the most reliable indicators. Again, please pull this chart on your own, federal funds rate, historic chart. And you can see the peaks here. This one, yeah, it actually peaked right about, and then the recession started, and then they started cutting in the recession. This one, you can see the rate hike cycle. You see the plateau. And again, we're talking 62 years, so that's several months where it plateaued, maybe 6 months, maybe more. Then the recession, and then the rate cutting cycle, right? And you can see they started cutting right before the recession was officially, declared. Rate hiking cycle, right? Rate cut, they start cutting rates, recession followed. Rates peak, they start cutting rates, recession followed. I think you can see the shaded lines. If you can't, you need to pull the chart on your own or go to the website, rightsideofthechart.com, look into that post. Rate hiking cycle, recessions right here in gray. I don't know if you can see it. And then I have another one here. Another rate hiking cycle, peaked, they start cutting, recession. Okay, guys, you can see them. Rate hiking cycle, cut, recession. Rate hiking cycle really started here. They stopped right there. They started cutting, recession. Rate hiking cycle plateaued for probably 6 months, 8 months. Then they started cutting, and the recession immediately followed. That was the Great Recession. The last one we had, there's a skinny line here when COVID hit. It was a brief, very brief recession. But again, rate hiking cycle, plateaued. So that's pretty compelling. If you don't think so, then I don't know what to tell you. That's, again, not a small sampling period. You can do the same thing with the yield curve. I encourage you as well. Look at the yield curve inversions and look at when the recessions followed. I didn't have that chart queued up for you here, but I can tell you it has had a 100% track record. And again, it's after the uninversion of the yield curve, which is all but guaranteed now if the Fed, because we're about to uninvert. And if we do get those cuts on the short end, that's what you need. You need the short end of the curve to come down more than the long end. Okay, quick update on crude. That was the recent divergent low. Remember the other day, I want to give you the trading plan. I had this stop. I think it was right here. At this point, being that we've come all the way up here, I got it right here last week, right after I bought it, put it in the video, and we were probably about right here. We went up, we hit T1. Again, these futures have rolled, but that's the same. When you're replicating a chart, if you're going to do the same thing, roll to the next month futures, or you trade USO, for example, all you have to do is look at the reactions and see where I've drawn those lines, and that's how you come across it. So if I don't give you the USO chart, or you want to trade OIL, which is another, if it's still around, there's other crude ETNs, you can do the same thing. That's it. We hit T1. You had an opportunity to take profits. We pulled back. You could have had an opportunity to recycle back in on the pullback. Again, if you're active trading, you hit T2. We pulled back again. And look, where did we pull back to? Well, we pulled back to T1. Remember, guys, this is simple. The way it works, doesn't always work out perfectly, but I can tell you definitively the way it works in technical analysis is resistance, which was what T1 was, and that's why we got rejected off the initial tag of it. Once broken, then becomes support. So we broke out, and we didn't just limp on through there. When we broke, boom, after some consolidation, which is all the better, that's that energy building like a coiled spring, we broke out, ran up, hit T2, pulled back, give you an opportunity to take profits as an active trader, and then recycle back in. So you sidestepped what was probably, 3-4%, 2-3% give back. And so now that should open the door for T3, T4. I also view this as a hedge to any index shorts, because this is a bet. If the stock market's going to continue to go up, and it can for a while. Everyone's giddy on the fact the Fed's going to be cutting, and they think that's going to be stimulative. And again, it is overall, but if you look at where rates are compared to where they were, we're still way higher than we were when the market bottomed back in October of 2022. But either way, my point being that if you want to buy into that whole no soft landing, or at worst a soft landing, but 2024 is going to be a strong year, a lot of growth in the economy, then you want to buy back into commodities. What you're going to see, if the Fed starts backing off, you're going to see that reflation trade coming back, inflation. So commodities, and we're seeing it now, and they have been since the Fed meeting. Commodities have been moving up. So anyways, you can view that as a hedge, because and we're going up more, by the way. I'm making more on the like on crude, for example, than I'm giving back on a QQQ short recently. And I think that'll continue. And then USO, I had the lines. I have a lot of lines on the chart. They're former support, resistance, targets from trading this one. But there was a breakout of the comparable or similar downtrend line. We were in, a little earlier on the CL chart, but that was the level I had in the video, was it last week? And that aligned with T2 on CL. And, you can see you've got pretty good resistance up here. So that's probably in line with that T4 level. And remember, kind of bigger picture stuff, big divergence has been building here. So plenty of potential crude wants to run. And NG, we'll leave the stop where I threw it out there recently, down here, just above the recent low, which was a divergent low. And we've been moving up. That was the first target, I believe, at about 250 right there. That was hit. There was a gap. And then you have some minor resistance here, which checked the advance, but there's a pullback. So, again, opportunity to load back up. And again, the stop will be, or stops are always dependent on one specific and unique entry cost, whether it's a one single position or they've been scaling in. But still, we took out the downtrend line following the divergent low, and we'll probably continue to zigzag on up in natural gas as well. And same thing with wheat. You had an opportunity. T1 has been resistance. This was first entered back here. Excuse me, entered back here, hit T1, pulled back, made a marginal new, but just slightly divergent low, not enough to exceed a stop. These were the targets back from there, and they still are. We hit T1 again, following the even bigger divergent low. We had a divergent low there, and that's it. So we pulled back. We're in this little consolidation range, and we need to pop, the recent highs, just over $6, and that'll open the door for a move up there. Again, looks good not only on the 60-minute chart, but the daily chart, large positive divergences as well. So you're seeing, and I'm seeing a lot of money coming back into, commodities. I'm seeing palladium exploding off the lows. And this is, I haven't talked about this very recently in the last week or two, but I've been talking about it quite a bit over the last 2 years. And that is, if you recall, again, if you've been, on right side chart for a while, the vicious cycle or the negative feedback loop between, and this is kind of the catch-22 the Fed is in, between interest rates. So the Fed starts going easy, whether in rhetoric or in actions, talking about cutting, which is right now it's in rhetoric, and then actions are going to cut rates, and it's going to lead to spurt. And I think you're going to see more and more, because it's also because the charts are constructive. I think you're going to see more and more money moving into commodities and gold, silver, other agricultural commodities, crude oil, all that stuff. And so the Fed gets easy. Commodity prices and equity prices, but really commodity prices are going to give us that inflation. They don't count the stock market in inflation numbers, but they certainly do count the finished goods. Commodities are at the the raw level, but then if wheat goes up 100% and corn and everything else, eventually a loaf of bread's going to increase in price, not by 100%, but it's going to go up. So that's the negative feedback loop I'm referring to. And so again, I think we'll continue to see this. And then as this starts to get priced in, this pop here in palladium, and especially the pop in crude oil. And again, should this morph into more of a trend instead of just a bounce, and we start seeing crude get back up here, and forever and a day, I use DJP as my kind of a proxy for figuring where CPI was going to come in. You can look at every single month. This is just a broad-based commodity ETN, has everything in there: crude and grains and agricultural commodities, industrial metals, precious metals. You got it all in there. And so this is our inflation. So this is what allowed the Fed to pause and then start talking about cutting. But mark my words, see this range here? You start seeing this come back up and especially break out, and that's going to say the battle is not over. I think Powell was a little more cautious than who was it, George W. That after Desert Storm, declaring victory on that battleship, and that proved to be a big faux pas because we were still entangled in the Middle Eastern wars for many years after. And so Powell knows better than to outright declare victory, but he kind of did, really, and especially by indicating that they're going to cut now, that they've stopped raising rates and they're going to cut. So he might not have come out and cheered, hey, victory, hell, we beat the inflation. But anyways, guys, just watch this. I don't want to. This I promise you, this is going to dictate what they'll be able to do and how much. If and when they'll be able to cut rates and by how much. And again, this is no bueno for the stock market and interest rates. Whereas if we continue to see this, then absolutely, that'll be very deflationary and give the Fed plenty of room if they want to cut. And most ag commodities overall look pretty good right now. But this one, I still think there's a lot more downside. I'm still short OJ futures. Again, there's not an ETF or an ETN out there that trades them, but there was just a beautiful parabolic. This is a parabolic trend line. I've yet to ever seen a parabolic advance on anything. This is what the NASDAQ looked like in 2000, the dot-com bubble, and we all know how that ended. And I've traded many parabolic trades since then. This is it. So the parabolic trend line has been broken. It's working its way down, so far from the high. I don't know. It's well into the double digits. But these are, this is a minor support level. But when I roll back here, this looks like a likely return point. So it still has us getting cut almost in half. We were about 450 going down to about 232. It's got a ways to go, but still looks like it's headed a lot lower in my opinion. And this is just another board on OJ futures. If you're in that one, there's a primary uptrend line we're coming up to, a pretty significant one. Shorter term time frame, so it's not parabolic, but you break that. And again, you can see that's around that 232-ish level right there. Some pretty decent support. So that would be from where we're at now, still, if hit, another 37% down to that level. I'm sure I'll get questions about gold. I don't have a very strong opinion. This is kind of a sloppy chart. We've had so much going on right now. It's been in the last week a slew of, we had all the big central bank meeting. Today was earlier today or late yesterday, however you want to look at it. BOJ, Bank of Japan, they decided to keep negative interest rate policy. And then before that, we had the ECB, and just before that, the Fed. So you can see gold, and I'm saying that because gold is not 100%, but 90% just, trades off what the dollar's doing and what the euro's doing, and to a smaller extent the yen. But I don't have a strong opinion. I just want to tell you right now, we're kind of just grinding around. And if I look at GLD, longer term, I'm still bullish longer term based on my outlook for both gold, the dollar, everything else. But mainly just gold, I'll tell you. But you've just put in a big divergent high, and it's just been kind of choppy lately. I don't have a strong opinion, so if I do, I'll let you know. But that's it on the daily. 60-minute looks like this. Remember, we had that divergent high. That's when the euro corrected and gold corrected, and there we are. I don't know if enough of that has played out already in the chart. So, all right, guys, it's a pretty short video, and I can cap it here. But I do want to address the small caps. I've talked about this, covered it extensively recently. This is a super well-defined trading range. So again, I like to say jokingly, a blind man can see this resistance here at about 200 on IWM, the small caps. And I'd be a fool not to recognize how powerful breakout could be. Again, my money is if it breaks out, and I'm talking a solid breakout. If you want to squint, you might say, oh, we popped a little above there today. Again, it depends where you put the line. I had a 199, you can see if you zoom in real tight, but we did have this one spike above there. I think any breakout, you want to know my thoughts, any breakout's going to look like this one right here, where you had a breakout, proved to be a failed breakout, and those are pretty damn bearish when it happened. Sent us back down to the bottom of the range. We got rejected off the top of the range there, got rejected off the top of the range there. Why? Because we're extremely overbought, as I've covered recently. What board did I have on? Here it is. Okay, I've covered this for you the other day, but nothing's changed. These orange circles here, which I'm overlapping in blue, show you all of the overbought readings. And then down here, the purple ones show you the high-level bearish PPO crossovers that came shortly after that. 1, 2, 3, even back here, orange right there. So without exception, again, without exception, since the bear market started back here, we had this, and now we have overbought, but I always say overbought's not a sell signal, it's a condition. What you could consider a sell signal would be a bearish crossover in the PPO. And the PPO is pretty strong right now. It's not at any immediate risk unless you had a really sharp down. So anywho, keep an eye on that. If it breakout, sometimes, and the thing about overbought, especially, guys, especially if I'm just dead wrong, and this market has another 30-40% upside, it's a new bull market, overbought can and often does stay and become more overbought in a bull market and stay overbought for an extended period of time. So we're watching this. Don't have a sell signal yet. Watch it. If something big happens, there is an island cluster of candles with a big gap down below. What I think happens, like looking at the chart, the price action, again, super bullish right now. There's no short sellers left in the market. Again, I showed you that with a declining short interest record or multi-year, at least a 52-week low, if not more than that. So I think what it would take when I look at the charts, when I look at these divergences that I've been talking about for a long time on QQQ, on SPY, you have it on the daily charts. The weekly charts especially, the big, very significant weekly and even monthly charts, QQQ, SPY, SOXX. I'm talking about these negative divergences. And the super bullish backdrop. And I get it. I get what the masses think. Oh, well, rate cuts are going to be even more bullish. The stock market's already at highs and we're looking at rate cut cycle. So what I think is going to happen, it just looks to me, I have a lot more faith in the charts than I have what faith in what the Fed is saying they're going to do or why they're going to do it. So it looks to me we're going to have to see. Here it is. I'm kind of predicting a black swan event. Now, black swan event by definition, you can't predict. They come out of the blue. But something I think is going to happen, that something's going to break. And ask yourself this. Why is the Fed talking about cutting? Why are they talking about 2 or even 3, depending on which Fed official, rate cuts next year? What is it that's worrying the Fed? All they've done now is returned interest rates to a normal level. Again, after years of artificially low rates, and they finally saw that they couldn't do that forever. And so all we've done now, if you look at, I'm just taking that line across, and we're at now normalized rates. I mean, my career, out of college, I went in, I was a stockbroker, worked in several major super regional banks, brokerage programs, and and I was, this is where I'm used to rates being back then. 7-8% mortgages. That's my first mortgage, I think, was, if I remember right, about 7 or 8%. CDs back in the day were 5, 6. Like, it's my view. I didn't, I was alive back then, but not. I did see a lot of these bonds coming due. I remember working at Merrill Lynch, and these old ladies would come in and give me their 16, 17, 15% treasury bills that were coming due, or treasury notes and CDs like that, and they were rolling them over down here, and of course they had to roll them down here recently. But all I'm trying to say, again, why would the Fed not just leave rates here? The stock market's doing well. Employment's at record low levels. So there's got to be some reason that both the markets and even the Fed are pricing in those cuts. The only thing would be most likely a recession, or maybe the Fed sees something in the financial system that's keeping them up at night. But we'll see. As of now, that's all kind of longer term stuff. You want to keep it short term. Just look at the 60-minute charts and let that be your guide, or the 15-minute charts. And there we are, still where I started the video. And we'll see where this goes today. I'm going to wrap it up here, get this one out to you, continue to hunt for new trade ideas, although I'm kind of, at my desk a little bit here and there in the holidays, spending time with family and doing other things. So let me get this one out to you. And again, if I see anything that stands out, I'll let you know. This has been Randy Finney with Right Side of the Chart. Have a great day.